Very happy New Year to you, to Neeraj, and everybody at NDTV Profit, to all your viewers as well.
Thank you so much. Manish, I remember a few years ago we did a conversation, and when you mentioned that fund managers like you don't have nerves of steel, now you have nerves of titanium because it takes that to do so, to do this business. Now, my question is, we've had a tale of two halves in 2024, very strong first half, if you will, and from a relative basis, a very wobbly H2 of 2024. What does 2025, the whole year or the first half, have in store? Volatility, unpredictability, or do you reckon that a bit of recouping from the second half losses of 2024?
So, Neeraj, again, we begin with a bit of pessimism as we step into calendar year 25. And this is on the back of a few things. All of that is very well known, but just to reiterate, there's no earnings growth. Earnings growth is low double digits. Okay, 10 to 12% sort of an earnings growth is what you can at best expect. Given how things are, things can change at the margin, but as we see things from our vantage point currently, we are looking at a 10 to 12% earnings growth. We are having an overvalued currency. You are seeing the FIs just press on relentless sales. I mean, that's not going to stop unless and until rupee depreciates more. So that is one. Third is the broader markets are grossly overvalued when we look at anecdotal data. Whether you look at the previous peaks of 2007, the Lehman crisis, 2017, we are at 1.5 times deviation away from the mean on the upside. So there's no comfort in the mid and small cap valuations per se. And the fourth is basically the plethora of IPOs, QIPs that have been pouring in. We are sucking out liquidity like anything. So India had the highest number of IPOs in calendar year 24, and the scenario doesn't look any better in calendar year 25. A whole lot of IPOs still lined up. Of course, it's a different thing that FIs are selling in the secondary markets, but buying in the primary markets. That's a silver lining. But that's how things are. Money is just getting pulled out of the secondary markets left, right, and center. So given all this backdrop, I think, again, you are dealing with two major events. The regime change in the US, January the 20th, when you have a new president come in, whole lot of measures that have been articulated by him. Whether that could come through sooner than later, it will have repercussions for emerging market as a whole. In totality, as we see the run-up to the inauguration of the new president or appointment of the new president, you are seeing a whole lot of selling that is happening across emerging markets. And obviously, India is a part of the emerging markets. It's advantage developed markets vis-a-vis, let's say, emerging market. That's one. The second is obviously the budget. And again, out here, the broad parameters are well known. You know the problems. You have a falling consumption. You have a falling investment by the government. Corporates are deleveraging the balance sheet. The government is deleveraging the balance sheet. There are articulation about containing of the fiscal deficit to 4.6% of GDP for fiscal 26. All of this doesn't bode well for growth. So, these are some of the parameters that we'll have to look out for as we move into the first quarter of calendar year 25 or the last quarter of fiscal year 24, and then see how the things play out for the rest of the year. There are a lot of challenges, and I think it will be a pick and choose as far as the markets are concerned. No low-hanging fruits. All the low-hanging fruits have been taken in the last 4 years.
Manish, good morning. This is Agam here. Are you, factoring in any sort of rate cuts for this upcoming calendar year? How could things potentially play out right now? Because you've suggested that growth is slowing down, but I reckon that RBI will still think about, inflation over growth. How are you looking at things here?
Yeah, so that's the conundrum. If you have a rupee depreciating, then the environment in India is going to be inflationary, and that's going to be a headwind for rate cut. Right now, everybody is building in rate cut by the RBI in the first quarter of this calendar year, or at best the second quarter of this calendar year. But should rupee depreciate another 3 to 4% from here, and the situation and the narrative could change, you really don't know. But right now, the fixation is preference of inflation over growth. The markets would love growth over inflation. That's the conundrum. I think probabilities of rate cuts are still high for the first half of calendar year 25, but it's not a given. A lot will depend on inflation. Right now, inflation is broadly under control, but who knows what's going to happen to oil prices and the rupee depreciation? What sort of imported inflation will you have in the country? I mean, all of that are still all up in the air.
Okay. Okay, Manish, it's not usual for me to see you sound skittish, let alone pessimistic, right? So when you're sounding pessimistic, there is probably reason galore for this. Now, my question, therefore, is what do you do in your portfolios? Unlike a retail investor who can afford to sit on 50% cash, maybe you can't take a cash call, maybe you can. So are you taking a cash call, part one? Or are you parking yourself in themes which could fall less? Or do you still find enough themes out there in this market? On last count, did you tell me there are 67 sectors? So are you finding enough themes to still make money in a market which may be sideways or may have a downward bias?
Yeah, so Neeraj, there are 57 sectors in India. It's very broad-based. The Indian markets are very broad-based. But I think the big theme for at least the first half of fiscal 26 is going to be your rupee depreciation. So you load onto sectors which are going to benefit out of a depreciating rupee, and these are large sectors. You have a pharmaceuticals, you have an IT, you have a banking system which will come out of lows of 25, and you have at the margin deposit accretion better than credit growth. NPAs are broadly under control. Of course, retail NPAs are now inching up, but corporate side of the book is perfectly fine, and valuations are perfectly okay. You have platform companies, both on the consumer side as well as the financial services, the parabanking side. Those look good. You have the insurance play where, again, you will come out of a very low base into a growth space for fiscal year 26 and 27. And again, valuations have corrected. So there are pockets where you will find islands of safety. Of course, by design and default, we don't take cash calls, but the idea is to remain in cash proxies. And of course, you have a Reliance, which is a good enough cash proxies or cash proxy, or you have large banks, both in the public sector space as well as the private sector space, which act as cash proxies. And, that's how you balance your portfolio in times of uncertainty and low growth. And as I said, that within the broader markets, because you have 57 sectors on an index-wide basis, the small cap and the mid cap index looks very, very overvalued, some 40p. We have never seen these sort of valuations on the mid cap and small cap index anytime before. But, there are still opportunities within individual names in the broader markets. And provided you take a 2 to 3 year viewpoint, you have enough opportunities. So I think, again, it is going to boil down to stock specific within the broader markets. And within the large cap space, you'll have these 4-5 large sectors where, you could have relative outperformance vis-a-vis the rest of the market.
Before we come to the large sectors, I'm tempted to ask you about opportunities, Manish. And, I remember being in the conference of the MK Brokers conference, while you were MK Investment Managers, you were still a customer for them and not an actual participant. Yeah, but let me, the one of the overarching themes out there, Manish, was two themes that I thought stood out in that conference, and this was 5 months ago, I reckon. One was energy transition. The other one was recycling. And I think both those themes have players, large, mid, small, but largely, if energy has large, mid, small, recycling only at that mid-size, small-size companies. In a lot of these companies, the valuations, Manish, seem stratospheric. So with an assumption that you like them, can I assume that valuations are prohibitive, or do you believe earnings growth will make up for the valuations even in the market construct that you've posted for us thus far?
So, Neeraj, first of all, these long-dated order book positions, whether it be the energy transition, etc., when the market tends to give valuations to these companies based on long-dated order books, I mean, this is something that is being overdone, and these will have to go through time correction and or price correction. So renewables, energy transition, these are great themes for the next 5, 6 years. But on the one hand, you have a arbitrage between, let's say, China, which is the biggest supplier of all energy modules. We're talking about solar out here, and a lot of bunching up of capacity because of the rush to meet this 500 gigawatts by 2030. After that, you'll really have the growth taper off. And here you have the markets value them so fancifully that there's nothing left on the table. So you're absolutely right. Both these teams are, very well placed between now and the next 5, 6 years. But there has to be some margin of safety when it comes to, valuing the earnings that you see over the next 4, 5 years. I mean, just that these themes will play out, can't really price them 5 years out in terms of earnings. So, after these go through some time correction, price correction, they will jolly well look very good for the portfolio. And this would run true for all the industrials, or let's say the government infrastructure. First of all, there's not too much of certainty as to how you can achieve a 4.6% fiscal deficit without containing your expenditure side or without building in a massive revenue. Government expenditure has to happen. But which areas will see an expenditure boost, which will see a cut, all of that we'll know in the budget. So the industrial side, the renewables, the power, these are defense, railway, these are slightly overdone. And because of the stratospheric valuations, they'll have ample room to correct before you can actually find margin of safety to be included in portfolio.
Nisha, how are you playing the theme of financialization of Indian savings at the moment? Is this going to be through, technology and finance stocks, or are there other areas that you could potentially look at right now?
Yeah, so equities as a percentage of financial savings is definitely going up. And this 5% of the total wealth of the country residing in financial assets, as opposed to, let's say, 15% in gold or 50% in real estate. I mean, this has changed at the margin during the pandemic, and it's only continuing. So again, out here, the profit pool where it's going to get shared between fewer number of players, I think there's ample visibility of not only earnings growth, but even multiples. These could structurally get re-rated. The exchanges, the wealth management platforms, the broking platform. Of course, broking this quarter is not going to be a great quarter, but because of the changes by the regulator. But from a long-term point of view, these are again buy on dips. You have the payment, fintechs. These again are platform companies where there's huge amount of non-linearity, and the delta in revenue and the delta in costs are not in tandem. The revenue line moves. There's huge operating leverage, which translates into superlative earnings growth, and this is not going to stop between now and the next 5, 10 years. And again, since the profit pool is getting shared between 2 players, 3 players, I think this is again a great opportunity, a great sector to own at all declines in the market.
Manish, I didn't get an answer to my other part of my question, which is small themes. I heard about railways and energy, etc. Let's say recycling, which is not really long-dated order books, but current work that needs to be done, right? And all forms of recycling, by the way. So let's start with that. I have a couple more.
Yeah, absolutely. These are great opportunities, whether it is electronic recycling or copper, or aluminium or rubber, just got to build an earnings growth and the valuations per se. But the whole point, let's say, talk about metal recycling companies. You have companies out here trading at 50, 60 PE multiples. Of course, for a 20, 25, 30% earnings growth, that's perfectly fine. So as long as PEG multiples remain less than 2, you still have opportunities in the individual names, whether it is rubber recycling or metal recycling or plastic recycling. I mean, these are great opportunities to own, but only mindful of valuation, nothing else.
Viewers, as per Manish, need to be less than 2 for you to be making a bet into recycling. Remember, stocks like Gravita, etc., great company, of course, doing great work here, but the stock has come off a little bit from the highs of the day, highs of the year, if you will. So keep that in mind. Manish, the other thing is this whole, I mean, this Unimec Aerospace and the kind of listing that it did has brought this whole ecosystem of defense, airspace supplying companies into focus. It's a nice little belt that is getting formed in the southern part of India. Again, expensive companies, but great entry barriers out there, I guess. Global suppliers, supplying to Boeing, Airbus, so on and so forth, other defense global names as well. Good enough, or again, valuations too steep?
No, so precision engineering is coming up as a very big theme as far as India is concerned, not only from the point of view, let's say, electronic manufacturing services, the EMS space, but also, the aircraft and the orders that we have in even the MRO space, the maintenance and repair operations within the aircraft, because India is going to import a whole lot of, airplanes between now and the next 5-6 years. All the major airlines are really booking a lot of planes. So this whole ecosystem regarding precision engineering, whether it comes to defense or let's say even MRO or let's say EMS, there will be individual companies which will have heightened earnings growth. And the whole crux out here is to see how good an earnings growth you'll have. And this again will rest on how good an order book position you have. But again, out here, it is the same thing, long dated order book position, if you value it too soon, I mean, at some points in time, these companies will go through time and price corrections. You tend to, I mean, the market tends to value these companies on the next 5 years sort of an order book position. I mean, it doesn't really work like that. You get the point that, yeah, you have visibility of the next 5 years, but there has to be some lapse of time before you start pricing in all that order book position into the market capitalization. And this will remain true as long as you have scarcity premium coming to a few of these names. You have a couple of listings in the precision engineering catering to the aircraft side and, Boeing and defense and all of that. But as you see more players, the scarcity premium in terms of valuations will also revert back to the mean.
Well, Manish, on that note, we leave it at that. Thank you so much for joining us and taking us through your views in the markets. We wish you, again, very happy in 2025. And we're really looking forward to and hoping that at least the economic parameters certainly improve. But there you have it. That's the word coming in from MK Investment Managers on how markets could potentially pan out going forward. On that note, we are coming to an end of this edition of